Hello, everyone. Thanks for checking in. I'm Mark, and I'm the stock market jobber. And today we're going to talk a little bit about what hedge funds really are. There's a lot of misunderstanding in the retail community about hedge funds. Now, I know exactly what goes on at hedge funds because I spent more than 20 years in the institutional trading world, and as the head of trading at three different money managers, I oversaw the trading of probably 10 or 15 different hedge funds in that time. So a hedge fund is an institutional money manager that manages money for a client. The difference between a hedge fund and just say a regular mutual fund is that in order to invest in a hedge fund, you need to be what's called an accredited investor, which basically means you have to have some money or some financial savvy. Whereas, whereas anyone can invest in a mutual fund. The other difference is the fee structure, and this is really the big difference. The main difference is that in a hedge fund, the money manager or whoever is running the hedge fund gets a management fee and a performance fee. In a mutual fund, all they get is the management fee, or in a typical institutional money manager, all they get is the management fee. In the hedge fund, you have a different fee structure. Okay, so now let's just say hypothetically a money manager is able to raise $1 billion, and who are money managers' clients? Well, mainly pension plans and maybe endowments. That's who really runs Wall Street. They're the people that need to have money managed for them, and the hedge funds and the other funds compete with each other to try to get that money to manage because they want the fees. Now, let's just say that we have $1 billion in a mutual fund and we have a 10% return. So that's a $100 million return. Well, the mutual fund, all they're going to get is the performance fee. So let's just say we have a performance fee of 1%. So they're going to basically get 1% of the $1 billion plus the 100 million. So that would be a little bit over $10 million. Now, let's just say a hedge fund has the same amount of money, but they have what we would call a 1 in 10. And they could be 1 in 10, they could be 2 in 20. But one, the first number is what the performance fee is. And the 10, that's the percentage of the performance fee. Now, let's just say in the hedge fund, you have $1 billion and you get a 10% return or 100 million. Well, the hedge fund manager, in addition to the management fee, they're going to get the performance fee. So they're going to get 10% of the $100 million that they raised or that they grew their assets. So that would be a $10 million performance fee. So that's it. Hedge funds can have really, really sophisticated strategies. They can be high frequency, arbitrage, as sophisticated as you can see. And the most sophisticated fund I ever traded for was what we call a 130/30, where you basically short 30% of your portfolio and you use that to put it into stocks. And there's high frequency trading. A hedge fund can also be as plain vanilla and as boring as you think. It's could be a traditional money manager that's deep value that maybe buys 5 or 10 positions in stocks, and maybe they trade once a quarter, once a month. It could be boring. Hedge funds could be really boring or they could be really sophisticated. The main difference is the fee structure. All right. So that's why hedge fund managers can make so much money. And hedge funds generally don't manage money for the people that work there. I mean, sometimes the people that work there have some money invested in it, but mainly they're investing money for, or they're managing money for their clients. Now, who are the clients of a hedge fund? Well, it would be wealthy investors or maybe pension plans, endowments. The top of Wall Street is really the pension plans and the endowments. They're these enormous institutions that need money to be managed for them. So just say I'm the head of some pension plan. I mean, I live in Connecticut, so let's just say I'm the head of the Connecticut State Retirement Pension Plan. And I say to myself, you know what? I want to have 10% of our money invested in financial stocks. So we look in a database and we find firms that find hedge funds or institutional money managers that specialize in trading or in managing financial stocks. And so we would contact them, and of course they want to talk to us and they want our business because they get the fee structure. So the hedge funds are managing money generally for the pension plans. Now, who are the pension plans managing money for? Well, the little person, right? Whoever has money in the pension. So I know this is kind of hard for some people to kind of get their heads around, but ultimately hedge funds are managing money for the little guy. So this whole little guy versus big guy thing is also a kind of a myth that's out there. A pension plan or a hedge fund manages money for a pension plan. The pension plan is managing money for the little guy. So ultimately, the hedge fund is managing money for the little guy. So that's really it. They're really not that mysterious. And it could be any kind of style of investment strategy. It could be a hedge fund. Remember, the main difference between a hedge fund and say a mutual fund or a traditional institutional investment manager is the fee structure. That's why these institutional money managers, or I'm sorry, that's why these hedge funds can make so much money. Now, a hedge fund could be a standalone organization, or it can be part of a bigger institutional money manager. Now, when I was at a particular institutional money manager, we had probably maybe 9 or 10 different products or management structures that we could offer to our clients or to potential clients. So this particular firm managed or had strategies and stocks in microcap, small cap growth, and small cap value. So this refers to how big the market capitalization is. So we're investing in companies that are small. We're not buying companies like Apple or Tesla. Now, we had to have different products to offer to different clients. So in order to offer something for a retail trader, or I'm sorry, a retail investor to get involved with, we had mutual funds. So each one of those strategies had a mutual fund. We had a microcap mutual fund, we had a small cap value mutual fund, and we had a small cap growth mutual fund. So any retail investor could invest with that. And in the mutual funds, there's generally a lot of stocks, and there was probably, I would say, between 60 and 80 stocks in each one of our mutual funds. Now, we had different things that institutional investors could invest in. We had 3 hedge funds. One hedge fund was a microcap strategy, one hedge fund was a small cap growth strategy, and one hedge fund was a small cap value strategy. So we would take out of all the stocks that were in the mutual fund, we would take the top 20 ones, or the ones that were our 20 favorites, the 20 stocks that we had the most conviction on. And that was what was in the hedge funds. So if a retail investor wanted to invest with us, they would invest in the mutual fund and we would get the management fee. If an institutional investor or an accredited investor wanted to invest with us into the hedge funds, well, they would pay the management fee and they would pay a performance fee. So if we had $1 billion and our fee structure was, let's call it a 2 and 20, which was popular, that means it's a 2% management fee and a 2% and a 20% performance fee. If we had $1 billion in the hedge fund and we had a return of 10%, that's $100 million, we would get a 20% performance fee, or $20 million. So we would get the $2 million management fee and we would get the $20 million performance fee. In a mutual fund or a traditional institutional money manager, all they get is the management fee. So the main difference between a hedge fund and other types of investment strategies is the performance fee. And that's why hedge funds can make so much money. And there are, everyone thinks like it's hedge funds are the smart money. Trust me, a lot of hedge funds go out of business. They're not necessarily that good. And they could be any style. It could be the most plain, vanilla, boring thing you could think of, deep value analysis, where you have accountants studying income statements and maybe you trade once a quarter or once a month. Or on the other side, it could be as sophisticated as it gets. All kinds of leverage, high frequency trading. But again, just to reiterate, the main difference between a hedge fund and a mutual fund or a traditional money manager is the fee structure. Hedge funds get a management fee and a performance fee. Other money managers only get the management fee. All right, so that's it. Hopefully that cleared up some myths, and I will talk to you soon.